We're really glad to have as a final lecture for today Professor Thomas Lux. He is from the University of Kiel. So he's a professor of monetary economics and international finance. And he has done a lot of significant work on stochastic and agent-based models of financial markets. I have been told that he's actually visited IMSC a long time back. Is that right?
Yeah, sure. Must be 15 years or so. Yeah. I have good memories of it.
Right. So I mean, and the next time you come to India, we'd love to host you again. So
I would be happy to come. Yeah.
yeah. So we're really looking forward to your talk. Yeah. So just over to you, please go ahead. Thank you.
What I want to present to you today is an overview of agent-based models in finance, their methodological foundations, some of their explanatory power and their applications. And to illustrate, so to say, what we have in mind, in a sense, when we speak about agents in financial markets, I have usually this cartoon to introduce that illustrates the layman's thinking about the agent's behavior in financial markets. Yeah? And part of that, I mean, not perhaps so irrational, but part of that we try to capture by agent-based models. And I'm going to explain to you a bit the foundations and the applications of these models. By the way, I should mention that I'm not only based in Kiel, but also for some time now at a university in Spain, University Jaume I at Castellón. If you want to see where it is, actually the two places are here, Kiel in the north, close to the Baltic Sea, close to Denmark, and Castellón is in the east of Spain on the Mediterranean. So here in Kiel, it is rainy and dark right now in the wintertime. In Castellón, there's a bit more sun typically. The plan of what is going to come is that I first expand a bit on the methodological foundations of agent-based models. Then I give you some indication of the explanatory power of such models. And finally, I move to the practical application on which I have been working a lot over the last years, namely the estimation and some applications. Estimation with different tools, there's a variety of things that have been applied to this kind of non-standard framework. To start with, what is an agent-based model? An agent-based model is a model where you have a pool to some extent of individual agents. And the important aspects here are heterogeneity. Why would you have agents? Because agents are heterogeneous, so they are not all the same. Otherwise, you could do with only one agent. And also the interaction in an economic context is important. And what you want to do with such models is to explain aggregate properties from the interaction, from the interplay of heterogeneous individuals. This is different if you want to categorize different kinds of models. This is different particularly in economics, but of course in other fields as well, from ad hoc models where you simply have equations and no underlying behavior of the agents. And on the other hand, in economics, particularly from what I would call reductionist models, where you only have one agent. And it's perhaps kind of implausible for colleagues from other fields who have no economics background to see that economics has actually for a long time been concentrating on represent agent models. So agent-based models, representative agent models. So agent-based models with more than a representative agent are relatively new to economics. You had often in macroeconomic models in finance, one and only one agent who was maximizing her utility or whatever it was over an infinite time horizon without any kind of interaction. So it's the typical Robinson Crusoe image for which economics has been criticized many times. And indeed, economics tries to move away from that and has kind of embraced to a certain extent agent-based models, but only relatively recently. Agent-based modeling has a lot of success, actually, if you look at different applications. One of the success stories is in traffic models, where they are combined with geographical information, where they have replaced formerly flow-based models almost completely. So we have complete agent-based models of the traffic system, the transportation system of certain countries in Europe. In ecology and epidemiology, you have an important application where you model the species and individuals, and that has been particularly useful during the COVID epidemic. There are applications, rather sad ones, of course, in military and security, modeling of combat, dispersed terrorist activity, impact of attacks on population. It is used by ministries of defense, for example. And beyond human agents, you can also speak about agent-based models in multi-body problems. If you look at large cosmological simulations, for example, that provide us with insights into the history of the universe. In economics, one of the most successful applications is actually the modeling of systemic risk in central banks that started after 2008, after the financial crisis, when it became important that the interaction between banks and not only the risk structure, the risk management of individual banks is important. And by now, every central bank almost worldwide has a department that does some form of agent-based model for the banking sector. In nonlinear optimization, things like genetic algorithms or swarm algorithms can be interpreted as agent-based models. In finance, actually, it goes back for a few decades. One of the first who did something like an agent-based model was actually Harry Markowitz, the Nobel laureate who introduced the CAP-M model. And he was relatively open to alternative methodology, and in 1989 published a paper where he had an explicitly agent-based model of trading in a stock market with different agents having different strategies like portfolio insurance and stop-loss strategies. And here you see the overall aggregate outcome in terms of the volumes of their trading activities that he reported in the paper on his simulations. ABMs in finance, what should they do? Now, as I said before, they should first explain the stylized facts. At the end, what we also want to do is create an artificial market where we can try to test certain measures that we introduce in real markets, like regulations, price limits, taxes on transactions, etc. And of course, practitioners want to forecast market developments. The type of agents can be very diverse. It ranges all the way from what we call zero intelligence, so very simple behavior with rules of thumb, and also very intelligent agents that use some kind of artificial intelligence tool. I have been working on both, and I give you a glimpse on different versions of these agent-based models, some with very simple kind of rules and some with much more intelligent behavior based on machine learning, etc. At the end, you want to predict market reaction. So there are some guys out there in investment companies that try to find out kind of trading opportunities via predicting certain inefficiencies of markets with agent-based models. The first and foremost kind of goal, however, has been to explain stylized facts. And to that, I will introduce you shortly in explaining what the most important stylized facts, as we call them, universal properties of financial markets are. Here you have a typical example, the New York Stock Exchange Composite Index over something like 15 years. That's the index itself in the upper panel. In the lower panel, you find what we are more often using in empirical research. This is the relative daily changes. And the relative daily changes are the object that kind of reveals some of the most important stylized facts. And these are the non-normal distribution of the returns. I here have the histogram of what you see here on the left-hand side, which is the blue bars, compared with the red line, which is the estimated normal distribution. And the important fact is that you have more small returns and you have more very large returns and less medium-sized returns in the shoulders of the distribution, which of course is very important, particularly for the large returns, because they are orders of magnitude more likely to happen, like these -8%, -6% that you see here in the bottom panel. They are kind of much more likely to happen than under the normal distribution. And that, of course, is important for risk and portfolio management for anyone who invests in the stock market. This is called the fat tail property, and you find it always. Whenever you look at something that you could call a financial market, not only stock markets, but also foreign exchange markets, for instance, or the price of gold, silver, etc., and even some commodity prices that have become kind of financialized, as it is said, then you find this typical behavior here. Yeah. And the second one, which is related to that, is what is called the clustering of volatility, also very clearly visible here, namely that in some periods you have a whole time window with very high positive and negative returns, whereas in other time windows, here for example, you have a time with very small returns. So they are not equally distributed across time, but they come, as it is said, in clusters, yeah, in clusters, which of course, again, is very important for risk management and portfolio management to know where you are, so to say, in the cycle of volatility. And that can be quantified by autocorrelations, and namely the autocorrelations of the squared and absolute return. So you simply take the square or the absolute value of this object here, yeah. And if you take the square or the absolute value, which is the blue or the green curve on the right-hand side here, you see that they are highly significant, which means that if returns in absolute value are high today, they are also very likely to be in absolute value high tomorrow and the next week and the next month and so on. Yeah. Whereas the returns themselves have autocorrelations, this is the black curve here, that are insignificant, which kind of shows you that you can't predict the sign. You can predict the extent without the sign, without the plus minus, but not so much the sign, yeah, which is the very particular behavior that we observe in financial markets. So these are the two most important stylized facts that are found universally. Yeah, it's not that there are any exceptions. Whenever you have a time series of trading going back to the 19th century, etc., it looks like that. So somehow you might say this characterizes human behavior in stock markets and other financial markets. There's a histogram where you see that this applies more broadly. It's in a log format. Yeah. This histogram, slightly different representation, where you indeed see it applies to very different markets. I have the New York Stock Exchange, gold, I have the US dollar against the euro, and I have the Australian stock market, very different markets that all show the same kind of behavior. And in the logarithmic perspective, you also see the tails here, which are most important, that the large returns are much more often happening, are much more frequent than expected under the normal distribution, which in fact is the line that we have here. Yeah. So this is the universal behavior, and this can be quantified actually with a power law, with a almost linear slope, which means that the power here is equal to about 3. Minus 3 is the decay factor of the probability of large returns, which is a very precise knowledge of the probabilistic behavior of financial data and gives you some good assessment of the riskiness of an investment. Now, these are the things we want to explain. Yeah, these are the things we want to explain with our artificial financial markets based on agents that are interacting. And in order to give you some indication in how far, in fact, artificial markets can mimic the behavior of existing markets, I show you 3 of these return time series. And in fact, 2 of them are empirical time series, and 1 is generated from an artificial market. Unfortunately, we don't have direct interaction, so I cannot, you can guess for yourself, but obviously you cannot give feedback to me. So guess for yourself which one is the artificial one that we get out of the computer from artificial agents, and which one are the real ones. Think about it for a moment, and then make your choice. And I can then reveal what it is. These are returns. This is an exchange rate. This is the German stock index, and this is the artificial market. So you see, we get something that is very close to the real thing. Yeah, we are very close to replicating the empirical data. I have another one. So if you failed or were successful with the first one, you can try once more whether you see some difference between real and artificial financial markets. So make your choice. Indeed, this is again the exchange rate. This is the stock market now for Australia, and this is the artificial market. Yeah. So in both cases, we get something, and it's not kind of calibrated, not geared towards these real life markets, but it's just an example of the outcome of an artificial financial market, what I show in these plots compared to some real life counterparts. So how does that work? It works via the interaction of the agents. And before I come to some of the details, let me say a few more words on the methodological foundations. What happens here actually is that the macroscopic regularities, which are these fat tails, and the clustering of volatility that I introduced before, yeah, you see these features in our simulations and in the real-life markets, the fat tails, the large positive and negative returns, and the clustering of volatility, here a period with very high volatility, and then a period with lower volatility, that these emerge as macroscopic regularities from the interaction of the agents. Yeah? Which means somehow that you have statistical laws that apply in the social sciences. That has been, so to say, some years ago, when this kind of movement started, the revolutionary idea underlying agent-based models, that you can kind of formulate statistical laws in the social sciences, not only in physics. There are some forerunners like Majorana, a physicist in the 40s, Wolfgang Weidlich, a German physicist from whom I learned a lot actually, and others as well. And it has later on also learned by economists, namely that macro activity is the result of the interaction between agents. In fact, how spectacular that is as an insight is only kind of apparent to economists who have been living for a long time with the idea of representative agents, of Robinson Crusoes. Yeah? And also Mr. Kerman, a famous economist, said that there's no plausible justification for the assumption that the aggregate of individuals acts itself like an individual maximizer. It is the interaction of the individuals that you need. And this literature has then formulated what I would call the interacting agent hypothesis, namely that the dynamics of asset returns arise endogenously from the trading process. So they are ingrained in the trading process, in the way humans work. And this is in contrast to the former belief of economists, which is called the efficient market hypothesis, which says that the prices reflect all news that enter the market. Yeah? And the interaction of heterogeneous traders is not so important because they somehow manage to completely understand the importance of everything that happens in the real world. Yeah, so these are two different kind of interpretations of what is going to happen in financial markets. It is the real world interaction in the interacting agent hypothesis. In the efficient market hypothesis, there's some view that markets kind of, without any problem, organize themselves so to be perfectly efficient. And to prove that this is possible, as I showed you in the previous plots, we have to come up with interacting agent models, agent-based models that look like empirical financial markets. And in fact, we have seen that this is possible. Yeah? So how does it work? We look at first principles of interaction of agents. Let me skip that. And we adopt a view that is kind of borrowed from statistical physics, yeah, in which we replace interacting particles by market participants. And in physics, it's well known that interacting particles typically generate power laws, statistical features, and these statistical features here would be our features of volatility clustering and fat tails. So let me see how that perhaps can work. I introduce a simple framework with different types of traders, inspired by what we see in real life. I call them, as it is typical now in the literature, noise traders and fundamentalists. The noise traders are kind of trading, as it is said, on noise. So they think they know something but don't really, whereas the fundamentalists base their trading on an analysis of the earning prospects of the company whose assets are traded. We also allow the traders to compare profits between these two groups and to allow them to switch from the less to the more successful one. And we also allow for changes of what is called the fundamental value that follow a harmless process. So there's outside information that is fed into our model, and we have different traders who react or do not react to this outside information. Yeah? Because information is important in financial market. And this outside information is structured so, which is called the news arrival process, that it has neither fat tails nor clustered volatility. So we give the agents a sequence of news that is relatively harmless, so to say, and see what, so to say, the agents make out of that, what the trading process generates out of this harmless news. Yeah? Here is a bit more formally an excess demand function. So what does that mean? That's a basic kind of function describing the dynamics of the price, yeah, where we have different traders. Yeah, we have the noise traders that I mentioned, and the noise traders in the simplest model I will kind of categorize as optimists versus pessimists. There might be some herding model underlying that. The optimists believe in an upward trend of the market, the pessimists into a downward trend for what reason ever. Yeah. And X is the balance. Yeah. X is the balance between the optimistic and the pessimistic noise traders. So if X is positive, there are more optimists. If X is negative, there are more pessimists. TC is the trading volume of these guys, and NC is the number of these guys. And I just take them as constants for the moment. And in the first part, you see the log difference between what is called the fundamental value, yeah, what fundamentalists, analysts think a right price, an arbitrage-free correct price for this asset would be, compared to the current price. And if these guys believe the correct valuation is higher than the current price, they would buy, and vice versa. If this is smaller than the other, they would sell. Yeah? TF is the trading volume, and NF is the number of these guys. Oops. And beta is the price adjustment speed. P is the change in time of the price. So the price changes in time according to the trading volume of the noise traders, who might have arbitrary kind of optimistic or pessimistic attitudes, which might change over time, and the trading volume of the fundamentalists who believe in an anchor value, which is the fundamental value, make some calculation of what a correct price for the asset would be. And there is some market process or some kind of mediating agent. Typically, you have so-called market makers in financial markets who set prices, and these prices would be increasing or decreasing depending on whether what we have on the right-hand side is positive, that means more demand than supply, or whether it is negative, which means the opposite. Yeah? So without going too much into the details, the model looks like that, just kind of formal representation. We have the fundamentalists, we have the noise traders. The noise traders in the simplest version are pessimistic or optimistic, and we allow the traders, which are really individual traders, say 100 or 1,000 in the computer, to switch between the groups here. So an optimist might become a pessimist and vice versa. So the group numbers are changing all the time via some form of herd behavior perhaps, and they might also change between noise trading and fundamentalism by comparing the profitability of both strategies. Yeah? So that's what is happening. That's, so to say, the agent-based nucleus of this model. And formally, this is kind of represented by state-dependent transition probabilities. So in a sense, each agent is represented by a Poisson process and decides over time again and again what he wants to do, whether he is optimistic or pessimistic, or whether he wants to follow a fundamental strategy or a noise trading strategy. Yeah? And the overall market result is kind of the outcome of this dispersed asynchronous reaction of the agents. Yeah? A very simple model of this kind would be the following, where we have the simple kind of switching probabilities between the two opinions or strategies, say optimistic and pessimistic. We have a certain number of agents, and the agents switch between groups according to some rule, where V is a function that governs the frequency of the switches, and U is something like, I call it an urchin function that governs in what direction the switches go. And if you have simple herd behavior, this is simply kind of self-referential. Yeah? There would be a positive relationship of U with respect to X, which is the overall kind of dominance of positive or negative attitudes of optimists and pessimists. So if there are more optimists, then X is positive. If there are more pessimists, then X is negative. It's simply the difference between the optimistic and the pessimistic agent divided by the overall number of these agents. And that then simply means that an agent has a certain probability. Moving upward means becoming optimistic if there are many other optimists, and that he would have a certain propensity to become a pessimist if there would be a large number of pessimists. Minus times minus is plus here. Yeah? And it's all mirror imaged. High probability to become optimistic if there are many optimists, and low probability to become pessimistic. So it's a herding model, yeah, that allows our agents in the group to switch back and forth. Under herding, a majority might emerge of optimists and pessimists, but still some agents, because of their own motivations, might be in the other group. And alpha O and alpha 1 are just parameters for how strong that is, and later on I'm going to estimate these parameters, yeah, in empirical applications. And this would be called a sentiment index, which is nice because it's very close to sentiment indices that you find for stock markets, because there are surveys where the stock market participants are simply asked whether they are optimistic or pessimistic. So this object here has a real-life counterpart, actually, in many markets. And this is what you get for the underlying agent-based model, depending on the parameters, yeah, depending on what alpha 1 and alpha O is. Alpha O would be a general predisposition if it's positive towards optimism, or towards pessimism if it's negative. Yeah. So here you see different simulations with alpha O on the left-hand side equal to 0, so no predisposition, and alpha 1 being 0.8 in the upper panel on the left-hand side and 1.2 in the lower panel. In the upper panel, you see completely unsystematic motions. Yeah, I should say that X is limited to the interval between -1 and 1. -1 means everyone pessimistic, +1 means everyone optimistic. And so with A1 being relatively small, it fluctuates around 0. So the same number of optimists and pessimists prevails over time with small kind of spikes to positive and negative values. What is more interesting is that with a higher value for A1, we get majorities. Yeah? For a long time, depending on what the time horizon is, the agents are either here between periods 150 to 200, for example, in a negative, pessimistic majority, and then for a long time they switch to an optimistic majority. So there are really movements of the crowd back and forth, yeah. Really the panic that you sometimes see, that you saw in the cartoon, yeah, is replicated here, is modeled here. The panic that you often see and the euphoria in financial markets, in some periods they are panicking, in other periods they are euphoric, yeah, and it changes unpredictable from time to time. If you add something like a predisposition here, alpha O is positive or negative, it looks a bit different. You have a bias upward, but I'm not going too much into detail about that. The most interesting aspect is what we have on the lower left-hand side, these majorities of optimists or pessimists that, of course, then would drive the prices. We would have bullish or bearish behavior, and this can also change quickly over time. Yeah? So that's the most interesting aspect. And we believe that that has some kind of relevance for financial markets. If you look at the histogram of the distribution of the attitude of the agents, in this case, you see that the extremes are most likely. Yeah? The extremes means either an optimistic majority, depending on the exact parameter, where in this case you have 70% being optimistic or 70% being pessimistic. And as many optimists and pessimists, an equal attitude is very unlikely to be observed. So this is what we are going to look at, the switches of noise traders between optimistic and pessimistic, described by this very simple model. We allow for the adjustment of the price, and we also allow for, this is a complicated formula, I'm not going to explain that in detail, you can read that in the papers, and we are also going to look at switches between noise trading and fundamentalist behavior. Here you see a simulation of this model, where in the upper panel you see the same behavior of my noise traders, yeah, either optimistic or pessimistic, and switching quickly from panic to euphoria. And these agents are now used as the market participants in a financial market model, where the price is formed according to the first equation that I have shown to you. And the price, or the returns of the price, that means the relative changes, you see in the lower panel. And what you see is that this is already one of the examples of my artificial financial markets that looks like the real thing. Yeah? The returns have the large positive and negative spikes, and the returns also have the volatility clustering. Yeah, we have periods here around 400, which are very volatile, high positive and negative changes. And we have periods around 600 where we have very small changes. Yeah? So we get already the features of financial markets with this very simple minimal model. I mentioned also what the so-called fundamental value is. The idea or the assumption for the fundamental value here was very simple. The fundamental value is simply constant. That means all the dynamics is driven by these not fully rational agents that kind of are subject to herd behavior and might form at any point in time a euphoric or a panicking majority. And depending on what is happening with these agents, how the euphoria and panic develops, this also influences the market prices and generates returns that look like empirical returns. So it's actually extremely easy, obviously, to come up with an agent-based model that matches the behavior of empirical markets. Yeah? In more complex models, we use more intelligent agents. Yeah? As I mentioned already, we allow, for example, for switches between the noise traders and the fundamentalists, so that they don't stay in their group all the time. And these switches would be governed by profits. So you can let the agents compute the profits from their trading, the capital gains or losses, in the computer, in the model, and compare a noise trader, somebody who is subject to panic and euphoria, but of course, during euphoria buys, and the euphoria might lead to increasing prices where he makes a profit. You can compare this agent's profit with the profit of a fundamentalist who always buys only if the fundamental value that he computes is above the current market price. Yeah? And this is again kind of modeled with transition probabilities. According to a Poisson process, a trader will kind of be activated compare the profits with another trader, and will switch to the more successful strategy, yeah, with some other, as I call it, urging function, simply depending on the profit differential between the different strategies. And what happens then, in fact, is that we still get the same outcome, yeah. You can see some example here, where it's a bit more pronounced here. It depends always a bit on the parameters, yeah. The difference between the volatile periods and the tranquil periods is much more pronounced than in the previous examples, but that depends on how exactly the parameters are chosen. And you also see that the volatile periods depend on how many chartists, which is a synonym for noise traders, you have. So the noise traders create the volatility, yeah, and the noise traders kind of increase in number or decrease. Sometimes there's a dominance of fundamentalists, almost no noise traders, but then the noise traders again increase in numbers. And when they increase in numbers, they create a period of high volatility. And what I get then is that, in fact, the price is equal to the fundamental value, but only on average, yeah. And if I look, as economists like it, at equilibrium configurations, in an equilibrium, because there's nothing happening, the price is constant, the noise traders and the fundamentalists perform equally well, which means the population composition would be indeterminate, yeah. Noise trader and fundamentalist profits would all be zero, so the movements between the groups would be unsystematic. But this is not what is most interesting, because what is interesting is more than the out of equilibrium dynamics, yeah? And this is what you see out of equilibrium. Out of equilibrium, the group numbers change all the time, yeah? Change all the time. Sometimes one of the groups increases, sometimes the other group increases. If you have more fundamentalists, then you have a tranquil market. If you have more chartists or noise traders, then you have a more volatile market. And this is another snapshot from a simulation where I change the fundamental value over time, yeah, and you see how the price tracks the fundamental value over long time horizons. I have just kind of included here a constant distance, because otherwise you couldn't distinguish between the two time series. Excuse me. The changes of the fundamental value, as I announced it in the beginning, are completely harmless. They are random, white noise, normally distributed. But what the market makes out of that is sharing the empirical features, namely the fat tails and the clusters of volatility. Yeah? So that confirms kind of this idea that it could be the market interaction that leads to these stylized facts. That it's the typical way that agents interact in markets, with their kind of overreaction, with their kind of herd behavior, with their kind of reliance on what they call chartist techniques, etc. And not only most of them not only looking at the true fundamental intrinsic value, as it is called. So this is what we see here. I think I have to be a bit faster here. The general mechanism is in fact interesting, because you could say that, yeah, maybe I go back to that, because you could say that these are intermittent fluctuations, yeah, intermittent outbreaks, so to say, of volatility, which kind of makes these models similar to certain models that are studied in statistical physics and other fields. Yeah? It is intermittent behavior. The system has a certain tendency towards a stable equilibrium, but it is also always driven away from this equilibrium. There are certain phases of destabilization that lead to the outbreak of volatility. Yeah, repeated phase transitions, you could say. Yeah, the system has some kind of, you can show that kind of theoretically, it has some kind of boundary in terms of the parameters at which it becomes unstable. But it also has some inherent dynamics that leads to the stable part of the phase space. And when it is in the stable part, there are intermittent fluctuations that lead it towards the boundary of stability, and then you will see large intermittent fluctuations. Maybe I go back again to this one because it's very kind of informative. The broken line is actually the boundary for stability. The model is stable as long as the number of, or the fraction of chartists, noise traders remains below this boundary. But you see it gets close to this boundary from time to time, and then there's an excitation of large fluctuations. But then, in fact, the large fluctuations are self-correcting, and you go back to a stable phase. So it's a switch between stable and unstable phases that we see in the market, which very much corresponds to the switch between turbulent and tranquil phases. Yeah. So this is what we see happening. And we see that it holds for very simple models. The first one that I have introduced to you, which you could call econophysics models, where the traders that had these herding dynamics were kind of mimicking something like an Ising model of magnetization. But it also holds for much more complicated artificial markets. And it also holds for models where I introduce explicit utility maximization. So what is key actually is the diversity of agents, not what exactly they are doing. The key is that you have a multitude of diverse agents who are all interacting. What exactly their strategies are is not so important. So the result is that what we see in the market is the outcome of uncoordinated activity of trades. And it shares all the features of real-life markets. Yeah. And it also does not violate what is called informational efficiency, which means the lack of predictability, because also our market is not really predictable. Yeah? It has the fat tails and clustered volatility, but where it goes to, plus or minus, is not predictable. So this is called martingale behavior in financial economics. I skipped this here. Here's an example of a model where the agents are described by much more complex strategies than in the previous example. The agents in this model by myself and Sascha Schornstein, one of my students some time ago, has used agents that have all applied a genetic algorithm, that means machine learning technique, in order to formulate their strategies. And every agent has been independent, so there have not been fixed groups, but every agent had its own kind of set of genetic algorithms to extract information from the past behavior of the market. And what you see is that this market behaves pretty much in the same way as before. We have the fat tails, we have the clustering of volatility. So it is not so important what exactly the details of the market are. Yeah. And in fact, here you even have utility functions in a fully specified portfolio choice problem of the agents in an international investment context. So much more difficult, much more complex than the previous, more econophysics-oriented model. And you can go to more complex models as well that all share the same behavior. So I think the literature has been relatively successful in what has been done, I would say, over the last 20 years or so. We have started to get an understanding of markets as complex, you could say, ecological systems of traders, where the outcome is determined by the fact that there are different types of traders interacting. Yeah. And the system is continuously evolving because the traders try to find better methods to get a competitive edge over their competitors. And what it leads to is the bubbles, the bursts, the crashes, and also the statistical features that we see in reality. Yeah. If you want to kind of profit from these academic insights, and this is done by some market participants, you can try to kind of see whether with an agent-based model you can kind of mimic the behavior of your competitors and understand the behavior of your competitors. And basically that is what is happening with machine learning that is applied by some technically advanced traders. But I guess the advantage you can get can only be a temporary advantage because it's an arms race, of course, among traders. How would you use it in practice? Now, you can, for example, try to scan data for predictable structure, yeah, because if you have these kind of behavioral foundations, in some periods, of course, as we have seen, the market is tranquil, not much is happening. In other periods, the market is very volatile, and the volatility, of course, has some behavioral origin. Yeah? So the causation of the volatility can be understood to a certain extent. That you can do and try to scan the data for predictable structure. Yeah? We did so in a paper some time ago. And in fact, in these theoretical models, that's perfectly possible. Yeah? You can identify over long simulations certain windows of time in which there's a certain predictability. I showed it with an example here. That's a very long simulation of one of the models that I have shown to you before. Yeah, over 40,000 periods or so. And we scan short periods with respect to nonlinearity, causal structure in these data. Yeah? And what I showed to you here with the broken or shaded lines is broken or dotted lines are periods in which statistical tests indicate predictability. Yeah? So as a market participant, the first one would already have some predictability, but then for a long time, if you use these scanning, these statistical tests, you would not see any predictability. You would say the market kind of cannot be beaten, cannot be predicted by any as advanced as possible machine learning technique. And it goes on like this. And then for some time in the second panel, you see predictability. And then for a long time in the third panel, you see predictability, and then it vanishes again. So this is, of course, what inspires the fantasy of market practitioners. Yeah, in some periods, intermittently, you have predictability, and predictability always means that there's at least the theoretical possibility of making profits out of predicting the behavior of other agents. But it can get lost in the same model, in the same simulation for a long time, and it can reappear. So you would need very good machine learning and pattern recognition models in order to try and make profits from that. Yeah. I don't have so much time left. I want to say a few words about estimation, because that has occupied me for much of the last years. The literature that I have introduced you to has been kind of consolidated to a certain extent, I would say. The theoretical models can explain what we see in reality. So then, of course, the question emerges, we want to estimate the parameters of these models. Yeah? And we can do that, actually, in many different ways. Yeah? We can do that most easily when you have data on the behavior or the expectations of the agents together with prices. And in the following, I have an example where I have sentiment data, yeah, from a German company that collects these data for the German stock market. And they call it short and medium run sentiment. One is for the next week, and the other is for the 3 months future horizon. And they have categorical data, just like in the model, yeah, a bit more complex, because the traders can voice that they are very optimistic, plus, and plus, that they don't know zero, that they are pessimistic or very pessimistic, but we can very easily kind of include that in our model. They have weekly data, and it's actually an online survey that they conduct, which has about 2,000 subscribers ahead at that time, where kind of 25% were participating every week. And we can use this data actually to implement very much the simple what I called econophysics model that I showed to you. These are the data. This is for a certain time horizon, the DAX returns. This is the short run sentiment on the bottom. And this is the medium run sentiment. Yeah. The short run has some indication of kind of going to the extremes, positive and negative. So it seems as if our model could apply to that. And we can kind of estimate the model's parameters, even a model which is a bit more complicated, in a very straightforward way. We have this urging function, yeah, for the herd behavior. But now the herd behavior is not only for one sentiment variable, but also for the other. So in how much short-run sentiment influences short-run sentiment, and medium-run sentiment influences short-run sentiment and itself. And in how far also you can add additional features, the returns themselves influence short-run sentiment. We can add a diffusion process for prices, yeah, where we explore how much sentiment influences prices. That would be the predictability of prices that we try to discover here. Yeah? If there are significant effects here, then we can predict prices with sentiment. And this is a random term, of course, of a diffusion process. So it's a simple application with a slightly more complex model because we have sentiment variables and prices added in line with our standard pricing equation that I have introduced before in this lecture. The estimation is done by, that's pretty complex, by a diffusion approximation of this agent-based model, where you get a Fokker-Planck or forward-Kolmogorov equation for the transient density. And if you have the transient density, you can include that into the likelihood function. So for details, please consult the papers. There is a complex, but relatively straightforward estimation methodology for these models. Yeah? And here you see some of the results. For short-run sentiment, the parameters are like this. The most important one is this one here, because it shows that there's strong interaction between the agents. Yeah? It is like, and it is actually the alpha parameter that we had before. If it is larger than 1, then you have strong herding, and obviously that is what is happening here. The model is estimated in 2 different versions. There's also an interaction between the medium run sentiment, which is positive, and the returns. And then I go on. Here I have a model for the medium run sentiment, different versions, which shows that in the medium run sentiment, the herding is not so strong. Yeah, this is the important part. There's a bit of herding, but not so strong. So you wouldn't expect majorities of optimistic and pessimistic agents in the medium run sentiment, which also we haven't seen in the data. And so you can go on. I don't have time to go through all the details. I should also leave some time for discussion. So there are different versions of this model. What this comes up to is a distribution of the opinion dynamics, where you see that this is medium run sentiment against short run sentiment, that in short run sentiment, you have a high propensity for an optimistic majority, but also a certain propensity for pessimistic majority, whereas in medium run sentiment along this dimension, there's not much of such a phenomenon. And you can compare that to the real thing. That's the estimated distribution, and that's the empirical distribution, and you see it looks pretty close. Now, let me skip a few things because I don't have time. Finally, I also want to see how much the sentiment influences price dynamics, yeah, as I have shown to you before, and in how far I can use the sentiment in the price dynamics to forecast prices. An exercise like that you see here. You see the forecasts from this model using the interaction between sentiment and the price dynamics, where the price dynamics is the real movement of the DAX index over periods. And this table gives you the success of this forecasting exercise, which of course is not dramatic, but is there to some extent. What it shows, it is the typical way to show these things, is the mean squared error. That means the deviation between the forecast and the realization, yeah, in relation to a naive forecast. So the naive forecast would be a constant forecast, yeah. Constant forecast means the price yesterday is forecasted to be the price tomorrow. That would be the benchmark. And this shows to you how much, compared to this benchmark, our forecast on the base of the agent-based model improves. 1 would mean the same forecastability of both methods. Smaller than 1 means some success of our methodology. And the star means that the statistician would say the success is significant. This is both for one-period returns and multi-period returns. And you see for multi-period returns over longer horizons, there is a certain success. It still remains to see whether this is successful enough in order to beat transaction costs, etc. So this is another question, but at least we have a certain kind of indication here that with this agent-based model, you can predict returns to a certain extent. So this is interesting for the practitioners. I think I shouldn't kind of expand. I have more things to say if I would have more time, of course. Like always, there are other estimation methods, but I skip that and move on to my conclusions of what I wanted to communicate to you today. Where am I? Conclusions. The agent-based models that we and others have designed, in fact, can explain the behavior, the stylized fact of financial markets in a very generic and robust way. It's the basic interaction between heterogeneous agents that explains that. You can kind of formulate the behavior of the agents in different ways. Yeah. Typically, the models are robust with respect to that. So it's really the interaction. These ABMs can be interpreted in different formats as statistical models, econometric models, for example, state space models that you can use in order to estimate the parameters. There are many methods. I have only shown you a few of them. And in fact, the estimation in such a framework comes together with filtering. That means you can infer the evolution of important hidden variables. If you don't have the sentiment, as I had in the example I have shown to you, you can actually filter out the sentiment from the returns using a model like this. Yeah? And of course, it has some practical implications for forecasting returns, forecasting volatility, etc. Here's some literature of my most recent publications on this topic. Thank you very much for listening to me.
Thank you so much, Thomas, for a really interesting talk. So, yeah, so the floor is open for questions. Please go ahead.
Okay, so when you include agent sentiments, is it also possible to include cognitive biases that are seen with traders, like overconfidence biases or loss aversion, and then see how that can simulate and predict market prices?
Perfectly possible. It's perfectly possible. As I said, you can kind of frame these models, and there's by now a huge literature. I mean, the simple models that I have shown to you originate from 25 years ago. So there's a huge literature with each and every possibility of, as you said, cognitive biases, overconfidence, etc. And in many of these contributions over the years, you see pretty much the same outcome in terms of the qualitative behavior of the markets.
All right, thank you.
And of course, you can try and see whether some more intricate properties of financial markets can be explained with particular models. What I have shown here, it was only the most obvious stylized facts, the fat tails and the clustered volatilities that you have all the time. But of course, there are some more intricate features for high frequency returns in certain markets, in certain trading systems, for which perhaps you need particular models, particular models with particular behavioral assumptions. But so to say, the big features are mostly there.
Right. Am I audible? Can you hear me?
Yes, I can hear you. Yeah.
Yeah. So you mentioned stylized facts as one of the goals of ABMs, right?
Yeah.
Is it really universal across time? Like
It
if you
is.
take, so the exponents
It
and
is.
everything do not vary with.
Yeah.
Oh, I see. Okay.
It's
Uh,
quite surprising. So when I started to work on financial economics 30 years ago, it was a big surprise for me as well that they are called stylized facts actually, but this is a misnomer. They are not stylized. Yeah, in economics we call stylized facts things that are often there or most of the time there. But these things, fat tails and clustered volatility, are always there. They are really always there. As long as far as it goes, we have some data for the 19th century for the US stock market, for example, and they look exactly the same. Also, the changes in the technology, yeah, the electronic trading didn't change much of that. And in fact, they can even be summarized in something like statistical measures that are constant, pretty much constant for all markets. This was the number three, the famous cubic relation of the distribution of large returns. If you estimate that for any market, there's a long literature about that, you always come up with three, yeah, which is there's no real explanation in terms of words, but the explanation is perhaps the whole model, yeah, the whole agent-based model, because the agent-based models provide you with a similar result. And also, the clustering of volatility you can describe with similar statistical numbers for the decay of the autocorrelation in time, which is also pretty constant. So this is not really stylized, it's universal. I showed South African stock markets, etc. So even if you go to small countries, to exotic places, you mostly find the same. If a market is very regulated, so I once had been looking at data from the Iranian stock market, that looked very particular. So that did not fall under this regularity. But all stock markets and other financial markets where you have a sufficient degree of free trading activity share this feature.
Okay. Also, the noisy traders who keep switching between optimistic and pessimistic strategy, are there also zealots that come up in your model? People like agents who never change their strategy?
You could allow for that. I mean, it's stochastic. In my models, each agent is a stochastic process, basically a Poisson process, who wakes up with a certain clock, asynchronously in time, so it's continuous time, wakes up, then thinks about what is happening around her or him, sees others are optimistic, he was pessimistic, decides to become optimistic, looks at the price trend, sees the price trend is positive, and the others are optimistic, so he also turns to an optimist, or he kind of decides to compare his profit to that of another agent. He computes his profit, computes the profit of another agent, decides to change strategy. It can be actually that agents stay. I didn't check for that, but there might be some agents who stay with their original behavior.
You mean as an emergent phenomena, which is not...
Maybe, yeah.
Okay. Just one last question. You mentioned that for fundamentalists, you have a certain price which you are varying by hand. So, are there models or attempts at modeling some sort of theory of value which the fundamentalist can sort of follow? Like some rule in this?
This is all we do in financial economics. Yeah, this is all we teach to students, how you compute the fundamental value. There are many ways to do that, or not many ways. There are established ways to do it. How to implement them, of course, differs because you need expectations about the future. The fundamental value, the established way to compute the fundamental value is the expected discounted flow of dividends for a stock. Yeah. For that, you have to have the discount factor, which means the interest rate at which you take a credit. You have to have some expectation about the future interest rates. You have to have, in particular, expectation about the dividends. Yeah. How you come up with these expectations, of course, is not so obvious. Yeah. So anyone who wants to compute a fundamental value would have to form expectations about future dividends. That's how we learn it in business schools, in universities, etc. In most of my experiments, I simply assume there is some fundamental value which can be known, which I change as an experiment over time, kind of following normally distributed noise, in order to see what the market makes out of that. But there are also versions of agent-based models where different agents use different strategies to compute the fundamental value.
So what's the modeling approach there when agents can infer a certain fundamental price?
They can form they can form different expectations about future dividends because future dividends are not known. So you have current dividends, you can extrapolate, you can use different ways to extrapolate what is happening in the future. You can get additional information perhaps about the business practices of a company. So you can do different things. You can endow the agents with different statistical methods to compute future dividends, and then you feed that back into the fundamental value. They have different fundamental values on which they orient, which they use as the benchmark. One is buying, one is selling. It would be another way, so to say, to design an agent-based model.
Okay, thank you.
Welcome.
So are there any further questions? Yeah.
I have one question. So it might be like I might be mistaken. So most of the simulated models kind of look like stationary. And also like you pointed out, the agents will self-correct when they reach the stability axis. So I mean, how they are doing that? I mean,
now that is an emergent property. So financial markets need to be non-stationary in terms of the price because prices are non-stationary. That's why we hardly use prices for any kind of statistical exercise, but the returns, the relative changes of the price are stationary. What characterizes the agent's behavior is also stationary. It's a stationary process, which has a certain distribution. I showed some distributions. It might be unimodal or it might be bimodal, multimodal. The bimodal case was the more interesting one because it leads to a self-organization in terms of optimistic or pessimistic majorities, so buying frenzies or panics where they all sell. But how exactly it works, how exactly it looks like is self-organizing. It's the self-organizing process that happens among the agents. So what I do is I formulate the agent process. I see what comes out of that. Of course, since the models that I showed to you are not too complex, I can get some theoretical understanding of what is happening. I can kind of get some kind of idea why with certain parameters they kind of self-organize into this bimodal or unimodal structure. But it is what emerges as a macroscopic behavior out of the microscopic behavior of the agents. And of course, the more flexibility I give to the agents, the less I can anticipate what is happening in the model. As I showed shortly, if I use genetic algorithms or other machine learning tools for the agents, in the computer you have kind of a number of 100 agents, each one of them is using his own machine learning tool, then it would be very hard to predict ex ante what the behavior of this model would be. But nevertheless, despite this complexity, in the example I showed to you, it looked pretty much like the simple model. So, which kind of speaks for the idea that it's simple mechanisms of interaction that are enough. Even if the agents are much more clever, they do the same in some sense.